Market. It's a pretty incredible moment in markets right now. You've seen a 2-day very steep decline, both in equity markets, but also trouble in bond markets. When you look around, where do you think things go from here?
I feel like this is the first sell-off in many years. I have to think back, when was it different? Where enough people are wondering, is this a buy the dip? Maybe it's not a buy the dip. Maybe it's a phrase no one ever used before, a sell the dip. Because this is not going to get fixed tomorrow. I believe you cannot put the genie back in the bottle. The gravity of these changes are such, and we already see the reciprocal tariff now coming from China, and we'll see what happens this weekend, that even if it was undone, it would really destroy a lot of confidence that people have in their ability to plan, whether it's for a merger, or for CapEx, or for even just holding equities without knowing how some might be disproportionately hurt because they happen to source in Vietnam or versus Australia. And so I feel like this is a really, really important moment where people understand this is not just some sort of buy the dip opportunity.
Could you compare it to any other market moment, given that we have seen some declines as steep as since COVID? We have seen banks drop the most since the regional banking crisis, and same goes for the thing that you excel in, that's credit default swaps. You've seen serious widening to almost crisis levels. What is it compared to?
So in credit default swaps or in corporate credit, it all depends where you start from. We were starting just a few days ago from basically the lowest levels ever seen. And so the first thing to go was equities, which was not that surprising given how the Mag 7 had done. Credit kicked in pretty quickly. And now we're seeing dispersion in credit. We're seeing some credits, the ones more affected by trade, cyclicals, autos, even now banks, moving much more than credits that are traditionally more stable. So I think that just using a longer term historical perspective, and as somebody that manages money to try to protect against tail events, I have to think about 2020, 2012 with Greece, 2008, even more mild sell-offs, the flash crash, the sell-off in 2016 that was commodity related. This one feels very different because we also have lingering inflation, and so it will not be as easy for the Fed to throw money at the problem, or for governments to, when we already were coming out of this world where transitory and it wasn't transitory, that maybe they overshot in 2020 and COVID was like aliens came down from Earth and they needed to throw out their playbook. We have the legacy of Smoot-Hawley and what happened in 1930. This is really, really major, and you could see over the weekend something where there's the U.S. pulling back a bit, but the range of outcomes is so wide here, and markets started quite expensive, credit especially, so I think we could go a lot lower.
So when you say a lot lower, are you pricing in a recession at this point? What are your odds of a recession?
Right, so I'm not good at forecasting recessions, and I'm not sure anyone is, though I accept that there's probably some people out there, and it's not just coin flipping, but if you just take the wisdom of crowds, and we could take, the venerable Goldman Sachs was at 20 2 days ago, now they're at 35, and someone just went to 50. If you just take the aggregation of it, so if you use Polymarket, for example, Polymarket was in the 20s, which is already elevated. We did have an elevated chance of recession the last couple years. That went into the 30s, and we've hit 50 now, and I think many people's base case for the first time is we are going into recession. And I remember when people worried about recession in the Biden administration, and they thought, probably won't happen, but if it happens, it will be mild. You cannot throw away the real possibility that it is a severe recession, because there's so many changing parts and retaliatory moves, and Smoot-Hawley it was not the cause of the Great Depression, but it certainly accelerated how painful it was. And so I think about it in probabilistic terms. We talked about the probability of recession. There's also the severity, and the tails for how bad it can be are much fatter than in my prior experience when I was thinking about a slowing economy.
What does a severe recession look like in your view? What happens in that scenario?
My world's credit spreads, investment grade, so let's just take investment grade, which it was just 50 basis points using the liquid credit derivative index. It had never really been, since '08, lower than 48. We were at that kind of level, or 45. In the last few days, it spiked up to 75, but it's still very low. If I take the last 6 recessions, the range of how bad it got was 110 to 275. And if I go back even further to 2002, because these youthful looks should not convince you otherwise. I was trading credit in 2002, I was trading credit in '98. because of Enron and WorldCom, and that was its own thing in 2002, investment grade got out to 300 or 400 basis points. And so when I think about where we're only at 75 now, the roll down the hill, the avalanche, has really just started. And with equities, it's all about what are earnings going to look like. People today are saying, well, 17 times earnings isn't that bad because we were at 19. But what are earnings? Now we have to price in earnings declining because of recession and how severely. And so I really think that investment grade could easily go to 130, 150 basis points. It was 95, Sonali, December 2018. December 8, 2018, there was a skirmish between President Trump and Xi. That was a walk in the park, and we were at 95. So you could say, well, maybe that didn't make sense then, but 75 does not make sense now, and just yesterday was 65. So I think we are headed down the hill. I think it's going to accelerate. There might be something in between that stops the boulder, but I'm very concerned about a crash.
Does the Fed step in your view?
A lot lower. A lot lower. They're not there to prop up the stock market. They're there to protect Americans, and the protection is not going to be printing money or buying junk ETFs like they did during COVID.
Do you worry about stagflation?
I do. I was listening to Howard Marks today, and some of the great thinkers in the market, nonpartisan, some of them share great concerns that we have all sorts of risks. We have stagflation, recession. Really, for a volatility trader like myself, it's in some sense it's so interesting because the range of things that can happen is so broad, and you can try to find interesting trades to access those tails.
So how do you play this market? What works if you were setting up for more volatility, as you've mentioned, and potentially more declines?
Right. It's not too late to reduce risk. I look at, of course, the exit point, if you did so, would have been a lot better days ago. But this fear, to me, is something that only today, yesterday, we're seeing. We were worried for a few days, and now comes this news. It's not too late to take chips off the table and say, okay, I've given up in equities, I've given up a year of gains, or in credit, we're back at the 28th percentile instead of the 2nd percentile, right? But does this feel like a world that's on the better side of the 50th percentile? Doesn't this feel like a world that's on the worse half when you think about the known unknowns, the unknown unknowns, which are, of course, always present, but the range of them feels wider given the known unknown of how bad is this tariff war?